Um, Looking at the latest news, is this stock caught in a falling trend with, you know, glaring sell signals, or is it a strong buy that some are actually calling massively undervalued?
Yeah, it really is the ultimate market tug of war right now. I mean, the charts are screaming one thing, but the balance sheet is telling a completely different story.
Right. And retail investors are just piling in as if the bottom is permanently in.
Exactly.
Welcome to today's deep dive, everyone. Today is April 16th, 2026, and we're putting SoFi Technologies, ticker symbol SOI, under the microscope.
Yes, we are.
And our goal here is to really cut through the extreme volatility we've seen earlier this year and figure out what the data is actually telling us.
Right, stripping away the hype and the panic. Because, I mean, there is a massive amount of data to synthesize here.
For sure.
We're looking at conflicting signals from Wall Street analysts, massive multi-million-dollar insider moves, and, a retail crowd holding on for dear life.
It's a fascinating case study. It really highlights how the market struggles to price a company that sits right on that fault line between a hyper-growth tech platform and, well, a heavily regulated traditional bank.
Yeah, it's a tricky balance.
But hey, before we dive into the numbers, you know the drill. Please like the video, subscribe to the YouTube channel, and it is absolutely compulsory to leave your comments and feedback below.
We definitely want the debate to continue in the comment section.
Yeah.
And just establishing this early on, we're just having a natural human debate here, looking at the facts and sources. Strictly no financial advice.
Right, not at all. Okay, let's unpack this. Before we can even begin to guess where the stock is headed next, we have to look at what the business has actually achieved, right? To, justify its current valuation.
Definitely. Let's start with the current price. So as of the most recent full trading session, SoFi closed at $18.79.
Which was a pretty solid jump, right? Like almost 5%.
Yeah, plus 4.91%. And it even pushed to $19.33 in late after hours.
That's a strong short-term rebound. But contrast this with the 52-week range. The high over the past year was $32.73, and the low was all the way down at $10.41.
It's a brutal picture of volatility. A swing like that for a company of this size just means institutional money hasn't quite made up its mind about what this company actually is.
Yeah, but a massive milestone happened in 2024. The sources highlight that they reached their first full year of GAAP profitability.
It's huge.
It is. I mean, hitting GAAP profitability is basically like a startup finally moving out of its parents' garage.
I like that analogy.
Right. Like it's now a self-sustaining entity. It's paying its own bills.
And if you look at the 2025 income statement, that self-sustaining engine really revved up. For Q4, GAAP net revenue hit $1 billion.
It's $1 billion. Wow.
Yeah, representing a 40% year-over-year increase. And annual net income available to common stockholders was $481.3 million.
So diluted EPS hit $0.39. But wait, let me push back here for a second.
Go ahead.
Looking at the balance sheet, the trailing PE ratio is currently sitting at 48.7x.
Yeah, that's high.
Is that kind of multiple normal for a bank, or are they being priced like a tech company?
Well, the justification for that 48.7 multiple really comes down to the mechanics of their deposits. By the end of 2024, SoFi money deposits hit $26 billion.
Okay.
And that number is the key to understanding their operating cash flow, which ended 2025 on a super strong positive trajectory.
Wait, break that down for me. Why does reaching $26 billion in deposits matter so much for their lending business?
So when SoFi was just an app originating loans, they had to borrow money from other institutions at higher rates to fund those loans. They were the middleman.
Right. Which squeezes their margins.
Exactly. But by pulling in $26 billion in direct deposits from their own users, they built their own low-cost pool of capital. They pay the user a small yield and then lend that exact same money out as a personal loan at a much higher rate.
Oh, so they capture the entire spread.
Yes, it's the lifeblood of their business now.
Okay, so if the fundamentals show this thriving, profitable business, why on earth is the stock still trading so far below its 52-week high?
Well, the answer lies in the charts and short-term momentum.
Right, the action.
Yeah, the technical picture is actually bullish short-term, but really cautious long-term.
I noticed that. The daily chart shows the RSI, the Relative Strength Index, is at 80.8.
Which is universally recognized as overbought. Anything over 70 means the stock has risen too far, too fast, and is statistically due for a pullback.
But at the same time, the MCD is generating a buy signal at 0.53.
Right, and what's fascinating here is the tension between that short-term burst, the May buy signal, and the long-term caution.
Because they're trading above the 20-day simple moving average, but they are still trapped below the 200-day simple moving average, which is sitting around $24.05.
Exactly. The 200-day average is like a brick wall. So until it breaks that, the long-term downtrend isn't fully reversed.
Looking at the levels, we have key support of $15.56 and immediate resistance overhead at $18.80.
And if volume pushes it through that $18.80 cleanly, the next target is the psychological level of $20.
Okay, but let's talk about the order flow. The sources show moderately bullish pressure with heavy accumulation in what they call the golden zone between $15 and $16.
Yeah, institutions were loading up there.
But retail sentiment is overwhelmingly 96% long. I have to push back hard on this.
Let's hear it.
If the RSI is at 80.8, meaning we're entering overbought territory and retail is already 96% long, aren't retail traders just setting themselves up to get trapped at the top of a short-term peak?
That is the textbook definition of a crowded trade, honestly.
Yeah.
When sentiment is that one-sided, the upside is capped because every available dollar from that retail group has already been spent.
Right, they're just exit liquidity for the institutions taking profits.
Exactly, which is why we need to look at what the players, the smart money insiders, are doing. Are they aligning with retail or taking the other side?
Well, the analysts' consensus is currently just a hold.
Yeah, and the price targets are all over the place. The average 12-month target is $23.52, which is about a 25.2% upside.
But the spread is wild. The high target is $38 and the low is down at $12.
Wall Street clearly has totally different models for how this business functions. But the insider activity is where the narrative really heats up.
Here's where it gets really interesting. In March 2026, CEO Anthony Noto bought 28,900 shares at $17.32.
With his own money?
Right, and specifically to defend against short reports. It's like a ship's captain personally buying more tickets for his own cruise while the critics on the dock say the boat is leaking.
I love that. It really is the ultimate show of confidence. Executives sell stock for a million reasons, buying a house, paying taxes, but they only buy on the open market for one reason.
You think the price is going up.
Exactly. He's signaling that the short sellers are wrong.
But on the flip side, the sources show other insiders had net sales of $15 million in Q1 2026.
Yeah, but you have to weigh that correctly. Those sales were largely for tax-related dispositions. It's automated. When you weigh the CEO's massive discretionary buying against automated tax sales or a generic hold from analysts, Noto's move carries infinitely more weight.
So this all leads us to the ultimate debate. Is SoFi genuinely a misunderstood, undervalued gem right now, or is it a classic value trap waiting to spring on these retail investors? Let's look at the bull case first.
The best case recovery scenario. So bulls argue that the 30% revenue growth totally justifies the current valuation.
And the business is super diversified now, right?
Very. 43% of their total revenue is coming from fee-based sources.
Which lowers risk.
Massively. Fee-based revenue doesn't carry credit risk. You aren't lending money. You're just charging for a service. Combine that with the Noto factor, his deep insider confidence, and sustainable GAAP profitability, and it looks like a profit machine.
Okay, but what about the bear case? The downside risks. Because bears argue that premium forward PE of 33x is vastly overvalued for a financial institution.
Right, because there are still massive banking risks. The biggest downside risk being their exposure to fair value accounting.
Ah, right. Mark-to-market losses.
Yes. So SoFi uses fair value accounting for a lot of its personal loan portfolio.
Which means they mark the value of those loans to whatever the current market price is. But wait, why is that such a huge liability if interest rates shift?
Think of it like a car. You buy it for $30,000, but if a new model comes out, the market value of your car drops. Even if you don't sell it, on paper, you've lost money.
Oh, I see.
If global interest rates spike, the older fixed-rate loans on SoFi's books become less attractive. Their market value drops.
So SoFi is forced to record those losses on their income statement.
Exactly. Wiping out profitability on paper, even if borrowers are still paying.
And speaking of borrowers, there's the risk of deteriorating macro conditions hurting the personal loan book.
Yeah, when consumers get squeezed by inflation, an unsecured personal loan from an app is the very first debt they stop paying. They'll pay their mortgage first.
Right. So what does this all mean? Are the retail crowds simply ignoring the massive macro risks like rate shifts and loan defaults just because they love the user-friendly app?
If we connect this to the bigger picture, it really comes down to the macro conditions. Those conditions are totally out of SoFi's control, but they will act as the ultimate decider between the bull and bear thesis.
We also have to mention the $1.5 billion capital raise from December 2025. That convertible debt remains a heavy weight on market sentiment, right?
Absolutely. Convertible debt dilutes shareholders and creates volatility. Hedge funds buy the debt and short the stock to hedge, which caps the upside and traps retail traders who keep buying the dip.
So, having laid out both the bullish dream and the bearish nightmare, what is the actual timeline for this to play out? What's the outlook?
For the short-term outlook, there's an expected rally toward that $20 mark leading up to earnings.
And long term, the sources say management is aiming for a massive 38 to 42% EPS compound annual growth rate through 2028.
Yeah, their goal is to become a top 10 financial institution.
But this raises an important question, doesn't it?
It definitely does. Can a company realistically maintain a 40% EPS growth rate in a deteriorating macro environment? It's a wildly aggressive target.
Which means it all comes down to the deciding catalyst. Q1 2026 earnings hit on April 29th, 2026.
Yes, that specific date will dictate everything. It will decide whether the stock finally breaks back toward its 52-week highs or just continues its long-term downtrend.
It's the moment of truth, so I want to leave you with a final provocative thought to mull over today.
Let's hear it.
When the upcoming April 29th earnings report drops, will the hard numbers vindicate the 96% of retail traders who are long? Or will those macro headwinds, the rate shifts, the defaults, spring the ultimate value trap on them?
It's the million-dollar question. And just a final reminder, everyone, this deep dive was an exercise in natural human debate and critical thinking. It was an analysis of the facts, not financial advice.
Exactly. Well, that wraps it up for today. Don't forget to like, subscribe, and drop your own bull or bear case in the comment section. Are you siding with Noto or the macro bears? Let us know. Thanks for hanging out with us, and we will see you on the next deep dive.